Good morning, everyone, and thank you for joining us for the latest edition of TAM Talks, titled What About Brexit? Before we begin, I'd like to go over some housekeeping rules for those who are unfamiliar with this format. Below the presentation, you'll see various tabs. Now, you can find a copy of today's slides under the attachment tab, which you can keep for your records, of course. Questions can be sent over to be answered by James in the dedicated Q&A session via the questions tab. And you can also rate today's webinar, which really does help us tailor future presentations and make sure they're relevant for you. So, with everything that's going on at the moment, from COVID-19 to protests across the globe, there seems to be a topic which has taken a back seat after dominating headlines for what seemed like an eternity. Today, James will provide a market update and then tackle the very relevant question, what about Brexit? James, over to you.
Good morning, guys. Thank you very much for dialing in. As Joe talked about there, I wanted to start with a market update for what continues to be a very polarized market. What we're seeing is nothing short of, well, it's pretty phenomenal actually from where I'm sat kind of at the coalface. Markets continue to trade quite volatile. I don't know if you've been watching the indexes, but 1% moves up, 2% moves down, 5% moves down. They're not uncommon. Now that's synonymous with a highly volatile market. So that translates into kind of a lot of fluidity when it comes to how people are thinking about Brexit. Sorry, not Brexit, how people are thinking about the COVID crisis, which still dominates the headlines, and how they're trading it. Kind of the more recent moves that we've seen outside of last week. So if we go back a couple of weeks before that, we saw a lot of positivity in markets. We saw headlines saying the S&P and the NASDAQ had reached all-time highs. The S&P had completely erased the losses from COVID. So we're now back to that kind of high water mark. It's almost like stock markets, the level that stocks are trading at the moment, especially in the US, it's like COVID never happened. But the problem that we have is obviously earnings have been downgraded. So the PE multiple, which is the difference between price in the stock market and the earnings of a company, is even higher at the moment. So at the moment, the only time that the PE multiple in the US has been higher than where we currently are has been the dot-com bubble. Take from that what you will. So what we saw over the last couple of weeks, say 3 weeks ago, was a very much a cyclical rotation. So a lot of investors were buying the trash. So dash for cash was what we saw in March. That was for safety. We're now dash for trash. So that was very much the beaten up airlines. It was the beaten up stocks like Cineworld. I don't know if you read about Hertz going up a huge amount, even though it's bankrupt. That's a lot of people, a lot of investors taking an outsized bet on things that are going to accelerate. So the market moved higher, very much on those stocks, not on the big tech stocks that held up and rallied hardest over the last few months. So growth funds really didn't do very well over the last few weeks. Value funds, those cyclical stocks, those stocks that are more exposed to COVID, they did very well. And then as we moved into last week, you saw a retracement of that. You saw the sell-off. You saw a bit of negativity come back into the market, sparked off by that very big sell-off in the S&P of about 5 to nearly 6%. UK markets down, European markets down. That was predominantly on the anticipation of a second wave coming back to the global economy. Now that started in the US, and the fears were around some of these states like Texas reopening too fast, infection rates starting to go up. A lot of people arguing that the US was reopening far too early. In fact, they were reopening when the virus numbers were still going up. So very much a fear around a second wave, and that saw the markets retrace back a lot of the gains that they made during the month. Again, unsurprising, it was a lot of the value stocks, it was a lot of the cyclicals, the Cineworlds, the gyms, the airlines that saw the biggest losses. So, if you just held a diversified portfolio through that volatility, you would have come out the other side exactly the same place that you'd been, but it would have been a bit of a roundabout journey. As you can see here, markets have gone up quite considerably and then retraced down. So we've not gone too far, but the journey has been volatile. And I think that's the message that I want to kind of portray as we go forwards, is expect much more of this. Expect a lot more fear and joy, and then fear, and then joy, and the markets will move and they'll flip from side to side as investors begin to price in what this market's going to do. The main thing is that we are now out of lockdown. By and large, shops opened up on Monday. So they're non-essential shops, sorry. So predominantly speaking, most retail is now back to work. Most of the service sectors are now back to work. So what we're going to start to see is how the economy is reacting. Everyone knew that there was going to get a rebound. All these headlines around economy starts to bounce back. That's fine, because we're bouncing back from virtually zero. So we're always going to get a bounce back. The real question is, are we going to get back to pre-COVID growth levels? And if so, when are we going to do that? If you look at the S&P, they're betting that we're going to get back to pre-growth levels pretty quickly, because the market is already at all-time highs. It's back to where it was pre-COVID. So there's a huge amount of risk. The market is priced for perfection at the moment. Anything lower than that, any worrying growth signs coming out of the market, any concerns around corporate's ability to generate revenue, that's going to cause a bit of stock market volatility. So as we go through these webinars, I will endeavor to give you market updates, but they will always start and end with the increase in volatility. That's going to be the main theme that governs markets, at least for the next quarter. Okay, so what I want to do is move on to Brexit, because Brexit, as you well know, has been in the shadows since the arrival of COVID. COVID's dominated the headlines. We're starting to see Brexit creeping back in. I've been reading, trying to count some of the headlines. That's how glamorous my life is here. Counting the amount of headlines in the papers that are now Brexit related and non-COVID related, it's definitely increasing. So you can expect to start to see a lot more narrative coming through about that for the rest of the year. I'd argue that probably it's going to overtake COVID in a few months' time. So where are we? Let's have an update. So end of last week, the UK formally rejected a transition extension. The transition extension was probably the consensus trade about 5 or 6 months ago. As we moved into COVID, everybody thought, you know what, Boris Johnson is definitely going to ask for an extension. This was one of the hardest trade negotiations to do, and we had left ourselves 12 months, legally 12 months to do it. Nobody believed that it could be done. COVID provided him the perfect cover to extend it. Well, that hasn't happened. That's definitely a shock to the market. And on Friday, they formally rejected that, despite the fact that the deadline for rejecting it is actually at the end of this month. So despite the fact that we've formally done it, we still have a bit of wiggle room if we want to. The narrative as we run up to kind of where we are right now from the UK government has very much been PR-led. It's very much, you know, these are the Europeans' problems. The Europeans are being too hard-nosed about what they will and won't negotiate on. We're doing everything we can to try and open up negotiations. We're very positive about a deal, but it's the Europeans that are not. That's the message that's been put out from the majority of the UK government. That's not strictly true. I reckon that's more PR than it is actual fact. Evidenced by news out the other day that they were having a light touch border controls put in. That means that UK trucks can leave the UK in Calais and Dover without having much checks. That's fine, that's great, but that's predominantly a PR stunt, because we both know, or we all know, that the checks are going to be done on the Calais side. So whether the trucks are held up here or held up in Calais, it doesn't make a difference. There's still going to be a fallout. There's still going to be an impact. The French and the Europeans came out and said, well, of course we're going to do that. And if you look into the fine print of this light touch border control, it only applies to UK trucks, UK exports. European imports, they're going to have big checks at Dover. So it's, you know, it's the UK government saying, we're doing everything we can to make this transition as smooth as possible, but really it's exactly the same. We're playing the same game as the Europeans. So it's predominantly a PR game at the moment. So where have we gone from here? So that was on Friday. So as we move forward to today, and this is great that we're having this presentation now, because this is when Brexit's really moving. This in the next few months, you're going to start to see more traction on Brexit than we have done in the last 6. The call done yesterday between Boris and Ursula actually made me quite positive this morning about Brexit. It was a very high-level conversation away from the negotiators at the coalface, a kind of a more partisan, hands across the table, come on, let's get this done. We both need this to happen. It seems like the Europeans are tacitly prepared to admit that they are willing to negotiate slightly more than they were. The UK are obviously willing to negotiate slightly more than they have been. So that's a real step away from this PR campaign to some hard facts. Conversely, off the back of the conversation, there were no hard facts. So we as the investors, as the electorate, have no further idea from the call yesterday about what's going to happen. There's no concrete agreement set in place. But again, it was more of a high-level conversation that can be taken by the negotiators at the coalface, that both sides are willing to negotiate slightly more. So I think that's really positive for Brexit. That shows that actually at the top, the top echelons of power in Whitehall and Brussels are more keen to negotiate than they've previously been letting on. Again, we're only really allowed, the only information that we get on this is from the news, is from the press, is from op-eds in papers. So they're very positive. What's happening behind closed doors remains to be seen. But again, I think that's something more positive than negative right now. So just touching on kind of the bones of contention around those negotiations, and what seems to be causing the real problems at the moment. I don't know if you've been reading, but definitely I've been reading. It's almost entirely around competition law and fisheries and farming. That seems to be what's generating the most news. It's what's been dominating the headlines. Obviously, competition law, the EU are very, very keen to stress that British companies cannot have access to the European market and have an advantage over trade. And the EU want access to our fisheries. I've always found it quite funny. Our fisheries, whilst important to us, make up a tiny fraction of our trade. When you think about that, when you stack it up next to the city, and the European or the city's access to European capital markets, which is huge. So our services sectors dwarfs our fishing industry, yet the fishing industry dwarfs the services and financial sector when it comes to taking up headlines. So you can expect some sort of concessions on the fishing and farming, but what the UK really wants is city access to European markets. They want goods and services. That's what we're looking at. But obviously, we need to come across the table in terms of equivalency rules when it comes to competition. So there are a couple of bones of contention that are still flying around, of which these are the main ones: competition law, fishing and farming. They seem to be grabbing most of the headlines. Again, highly negotiable. And I think it actually sounds like both sides are willing to come to the table a little bit more, despite the fact that we've only got nearly 6 months to set in place one of the largest trade deals that's ever been done. It took Canada nearly 7 years to do a trade deal that's smaller than this one. So they've got their work cut out for them, but it seems like they've been given their lead by the leaders, by Boris, to say, look, come on, let's get this over the line. So why? Why now? First and foremost, COVID, right? COVID has, as we know, hammered supply chains. It's hammered economic growth. It's hammered global growth. It's hammered the global economy. And on the UK perspective, from a UK and a European perspective, they're already the conundrum of restarting corporate growth, of restarting the economy is so massive. Can they be prepared to throw in Brexit and protectionism and ripping up free trade access as we move into this highly, highly uncertain growth environment from COVID? My answer would be no. And my answer would be the politicians are probably going to do everything that they can to foster cross-border international trade, because it means that their corporates, it means that their economy out of this COVID hole faster, right? So you've got that huge motivational factor on both sides of the channel to get this done. Secondly, you've got Italy. You've got the stimulation. You've got the stimulus that the Europeans are trying to inject in their new EU recovery fund. That obviously is aimed at more of the periphery markets in Europe, such as Italy, such as Spain, to get them back on their feet as quickly as possible. One of the finer points of this fund is it's entirely COVID calculated. There is no calculation or wiggle room for Brexit. So there is none of the calculations to arrive at the figures needed to stimulate Italy, Spain, Germany, France have anticipated that the EU will have world trade tariff status with the UK. It's all been factored in at free trade. So if we have a hard Brexit, that EU fund is going to have to be recalculated to factor in the fact that these countries are going to have a massive load on their budget from the fact that the UK has left on a hard Brexit. So again, the Europeans do not want to have to be recalculating that COVID fund. So that's you've got COVID there, you've got the Italian flag, obviously you've got Brexit on the other side. So I'm just trying to illustrate the point that you've got COVID on one side, you've got Brexit on the other. Which one's more important to the Europeans? Brexit will hurt the COVID recovery program, which is more of a stimulus for the Europeans to try and get this done. Again, this is the stuff that's unspoken. This is the stuff that's going on in Brussels right now. Interestingly enough, I put Lufthansa in there because I think it's really interesting that the Europeans continue to talk about competition law and making sure that the UK companies have no advantage over European companies when you've got a European flight carrier there in Lufthansa that's being bailed out by the German government, and they're going to be flying to the UK. They're going to be competing for routes. Ryanair don't have that bailout. EasyJet don't have that bailout. So sometimes the Europeans, when they say they want, whiter than white level playing field in terms of competition, that's not what they're doing. They're helping out their own companies. They're helping out their own internal companies and giving them an unfair advantage. And that's something that the UK has been using as a bargaining chip to say, well, you can't talk about level playing field and then do what you're doing with Lufthansa. So again, the UK is trying to be a little bit more clever about this. So that's what's happening. In terms of what's happening at the end of the month, the only thing that's happening at the end of the month is this formal deadline to extend Brexit by the UK government. Now, the fact that we formally killed that on Friday means that there's not a lot that's going to happen at the end of this month. But the end of this month technically is the final deadline for that. Again, I don't expect any news to come out from that. What I want to do here is just pause for a second to talk about TAM and what it's doing in reaction to that. Our European entity, as we are coming online now and getting regulation with getting approval from the Spanish regulator, this is almost as a case study for how financial services should be, we believe, reacting to this. Is regardless of what we think, regardless of whether there's going to be a hard Brexit or a soft Brexit, what the WTO rules are going to imply, we have clients in Europe, and we need to service those clients, and we need to make sure that the service that we provide to those clients is as good, better than it ever has been. And things like Brexit, whether they come to pass, whether it's a no deal, whether it's a soft deal, whether we get a better agreement, it's kind of by the by in terms of the fact that we need to make sure that we are stepping up for those clients. And that's what we're seeing a lot of companies in the UK services sector, especially in financial services, not doing. So regardless of the outcome, we believe this is the perfect time to move into Europe. This is the perfect time to say to those European clients, you know what, we're coming to you. We're coming to you because this is so uncertain. This is such an uncertain landscape that we need to make sure that our service to you is concrete. And we think that's probably the most prudent approach to all corporates if they have
Hello, James. Apologies. It appears that we may have lost James for a moment there due to some technical difficulties. We'll give him a few seconds to see if he can rejoin. Such are the issues that we do have with technology at the moment. Everybody is working remotely, so apologies for this.
Joe, I can hear you.
Oh, you can hear me?
Yeah.
Oh, brilliant. Okay, apologies. Yeah, you just dropped off there for a few seconds, but it seems like you're back online now, so I'll let you carry on.
Oh, great. The wonders of the internet from home. So I'll carry on. In terms of just finishing off with Europe, we believe that it's the prudent approach to come towards our clients in Europe rather than stepping away from them and allowing the politicians to make the decision for us. Now's the time to step towards those European clients. And we believe that you'll start to see that more and more from the financial services sector. Back to Brexit and what we believe. So if I had to put a percentage on deal or no deal at the moment, to quote the game show, these are some of the percentages that we're thinking. 70-30. That's what we believe. Now, I widely held the view that Boris Johnson was secretly quite a hard Brexiteer, and he wasn't too interested in capturing a deal. I'm actually starting to reassess that view. I think, despite the fact that he might have some misgivings about Europe and really want the sovereignty and the control of our borders that comes with Brexit, I think there's a huge amount of pressure with the amount of the landslide victory that he had at the end of last year. I think he's now taken on a huge swath of Labour voters that have entrusted him to get a deal, that have entrusted him to get the country where it needs to be in terms of sorting out a trade agreement with the EU. And I think he feels the responsibility now to actually put his own views aside about wanting a hard Brexit and actually pursuing a deal. When it comes to free trade, Boris is a massive advocate of free trade. He believes it's the single biggest tool he has in his toolbox to boost UK GDP. And as we know, we need every single tool in our toolbox to boost GDP right now. And I've put it down there, the quote that he made the other day. Free trade has done more than any other single economic idea to raise billions out of poverty. That came from Boris Johnson. That is his view of free trade. That, to me, doesn't chime with a leader that wants to pursue world trade zero, that wants to pursue a deal with the EU that is dead, that has us trading on world trade tariffs. That is spoken of a leader that wants to sort out some sort of trade deal. So to me, that fills me with the confidence that we have a motivated leader that wants to get some sort of deal. So I believe that it's going to be 70-30. I don't believe it's going to be clean cut. I don't believe one day we'll suddenly go, yeah, okay, that's all done. I think we will get some sort of deal over the line by December. It won't be clear cut. There'll be other negotiations that need to happen. The UK and the European government will find some way of offsetting some of the negotiations to push them out and agreeing the meat of the deal by December. It will be messy, but I believe that we will get some sort of deal by December. That to me makes most sense from where we're currently sat. So let's talk about what it means for investing. Let's talk about what it means for TAM and our clients. TAM's obviously a UK manager. So what do we think about UK stocks? On a deal scenario here, even if it is a fudged deal, these are the types of assets that we see increasing, right? The pound, as we all know, has been depressed for a very, very long time on Brexit. It's remained depressed. Traders, investors just can't get behind the currency at the moment whilst we have this uncertainty. So the fact that we formally rejected to extend Brexit was actually a real positive for the markets because it gave the market some certainty. It gave the market some closure about when we're going to get an end to this. So at least we know by the end of December, we're going to have some sort of idea about where the pound is going. But we believe on a deal scenario, that's going to go up. The reason why the FTSE 100 is going to come down is because the FTSE 100 and the pound remain correlated. on the perception that obviously the FTSE 100 is full of international companies. International companies have their revenue overseas. An increasing pound is negative towards those earnings when you repatriate them. So those earnings are coming down. FTSE AIM, FTSE 250, full of very domestic-facing stocks. They're going to go up as positivity comes back to the fact that the corporate, the domestic corporate is going to benefit from that because we're going to have some sort of ability to keep exporting to the EU without tariffs. Again, domestic stocks going up, domestic stocks within the 250 and the AIM. So that's predominantly what we see as the base reaction from markets, especially in the UK. What do we see on a no deal? Unsurprisingly, it's the inverse, right? You're going to start to see pound hit a little bit more volatility as no deal scenarios turn up. Domestic stocks in the 250 and the AIM will also start to sell off under greater pressure. Domestic stocks will start to see the biggest sell-off as we have those supply chains in Europe ripped up and those companies' inability to continue to trade with Europe on zero tariffs. So that'll all have to be renegotiated. So as I said, that's obviously the worst case scenario. We believe 70% that there will be a deal. So we do believe in the secondary. So we do believe in the first slide where you're going to get positivity coming back to the UK market. How are TAM playing this one? That's very interesting. So I've put tortoise and hare here because nothing needs to be done quickly. As I said, Boris chatting yesterday, there was nothing concrete. There was no change that came out. There wasn't something that was going to be a huge catalyst for UK domestic stocks or UK international stocks to start rallying. So nothing needs to be done immediately. As we go through the year, we're going to start to hear more and more rhetoric coming out about the ability to negotiate. Just because the leaders say they want a deal doesn't mean that we're going to get one. So we need to be very careful and very balanced about our exposure. So I'm not going to start buying huge amounts of the FTSE 250 or lots of domestic stocks, and I'm not going to start selling down lots of international stocks. We need to remain diversified. Unsurprisingly, in the amount of uncertainty off the back of COVID and the amount of volatility that we're seeing, diversification remains so important. It remains paramount. Deal or no deal, we need to make sure that we're covering our bases and that our risk is properly managed. So tortoise and hare is very much tortoise. We're not jumping into the stuff that we believe is going to rally really hard on a deal. We're making sure that we're balanced. We're making sure that we're going to keep plodding along. High quality stocks remain key. That's off the back of COVID. COVID is not going anywhere this year. We're still going to have the hangover effects from that, even if we get a deal. So we need to make sure that high quality companies are still prevalent in the portfolios, and they remain the key driver for how we make investment decisions. And diversification remains key. So that's how we're playing it, is diversified, high quality. Deal or no deal, that's what we need to remain in. I will leave you with this, which is, let's not forget, however, that when it comes to global versus UK, we will obviously keep our international exposure high. We'll keep high quality UK investments as well. But when you look at the disparity between US and UK stocks, it is at all-time highs. You can see that that goes back to 1950. And you can see the disparity between the valuations of UK and US stocks is massive. So there's a huge opportunity here in the long term for UK assets. Now, COVID and Brexit and hard deal or hard exit and a deal still govern the short term, but long term there remains a massive premium to the UK market. And we always have our eye on that. That doesn't mean that we're now going to pile into the UK market, but we need to make sure that we're cognizant of that huge disparity. There's a massive opportunity there if we can start to unlock the potential of these UK companies. You need to get rid of COVID. You need to start recovering before we can start to see this. So that reflation of this trade is going to be a few years out, but we definitely need to consider it. Final word, Warren Buffett seems to be appearing in every single presentation we do. In the business world, the rear view mirror is always clearer than the windshield. As I've discussed, as we've just looked at that slide of UK assets versus US assets, that's rear view. So it's very clear what has happened before. It's very clear where we are. COVID is the most uncertainty we've ever seen in this market since the Second World War. In my career, it is the most uncertain this world has ever been. There are investors that have been investing for 30 years that say this is the hardest environment they've ever been in to make money. So the windshield, as we look forwards, is very unclear. Always clear when you're looking in your rearview mirror. But what we need to do is fall back on what we've always fallen back on, which is high quality. What is going to be here? What companies are still going to be around when the dust settles, whether they're international, whether they're UK? That remains the mainstay of our strategy at the moment, is diversification and high quality. Any questions?
Excellent. James, thank you very much for that. We've had a few questions come through here, which seem really, really good, really relevant ones. But we've allowed for 15 minutes worth of Q&A. So if anybody wants to send any over, please feel free to do so, and they will get answered. First question that we have here, though, is with markets so volatile due to COVID and Brexit, should clients be fully invested, or should funds be fed in gradually? Or is there a case for sitting in cash?
It's a very good question. Multifaceted. It speaks to cash as an asset class. It speaks to active management. Predominantly speaking, we are portfolio managers. We are stewards of capital. If we believe that there is risk to client capital, I feel much safer holding it in cash. There are some funds out there, some unit trusts out there that are by law required to be 100% invested. The flexibility of a DFM and a model portfolio means that we are not required to be fully invested. And in this environment, cash is most definitely an asset class. If you looked at the US market 3 days ago, it fell 5%. Right? That's 5% in a day. Now, if we can have a higher cash weighting and take advantage of that, then that's something that we need to do. So predominantly speaking, there is a case for sitting in cash. There is a case for sitting in cash as markets remain highly volatile, especially seeing as now we're approaching these kind of all-time highs in markets. We need to make sure that we have some firepower to put back to work if the markets do sell off again. So cash does remain key. Being fully invested, again, that speaks to active versus passive management. I have no problem being fully invested if that's what we need to do. But what's the composition of what we're invested in? How are we investing those clients' assets? And again, it comes back to diversification and high quality. We need to make sure that we have a proper allocation to precious metals. We need to make sure we have a proper allocation to the chance of inflation. We need to make sure that we have funds that benefit from a highly volatile environment. We need to make sure that we have high quality equity stocks, such as the Lindsell Trains of the world, such as Terry Smith's. So, it's very easy to make both cases. What we've done, what we've chosen to do, is be as fully invested as we feel comfortable with, keeping cash on the sidelines to invest when those markets do sell off, to capture that volatility. And where we are invested, remaining highly active.
Stuff. Segueing quite nicely from that first question, we have another one here regarding active versus passive investments, specifically in the UK. How are you and the team positioning your portfolios to active or passive investments, and where are you finding the most value at the moment?
So that's a good question. That's a question, again, that permeates not just the UK, but it permeates all markets at the moment, which is if you think about COVID, if you think about what COVID's done to the corporate world, there's going to be a huge amount of winners and losers. There's going to be a huge amount of companies that look great on a balance sheet, that have all taken government help, they've all taken government assistance, and sometimes those companies will continue to trade and they will continue to survive because of government assistance, but actually their balance sheets, their corporate model has been dwindling for a very long time. We like to call them zombie companies. So if you go passive into most traditional markets like the S&P, like the FTSE 100, you have no choice but to own those companies. As I think it's Warren Buffett who said, when the tide goes out, you see who's swimming naked, right? And the tide is going out, right? Corporate profits are coming down, margins are being squeezed. You've got you've got spending, you've got consumer spending, which is coming off hugely so, right? That's the tide coming out. We're about to see what corporations don't have a good accountancy. They don't have solid balance sheets. They have too much high leverage, and they've disguised it within their balance sheet for too long, right? And those stocks are going to start to be uncovered. Now, you have no choice but to own that in a passive instrument. Whereas an active manager can go through and go, you know what? I think that's what we need to avoid. This is what we need to avoid. This is what we need to avoid. So I think active management now, with the uncertainty in the corporate world about the winners and losers, and there will be winners, don't get me wrong, there will be winners. I think it is key for active managers to own active managers who can go through the market and pick out the gems and leave the trash, because they've done accountancy, they've done forensic accountancy on those companies, and they know that they're probably not going to be able to survive. So I agree. I mean, I give up the point that passive is a great way to get exposure to a market when it's rallying, and it's cheap. But at the moment, by and large, passive instruments are about 20 bits, 0.2% as an AMC. Active funds are about 0.8. What is access to the same active funds for about 0.4. So that's double the cost, but we believe it's well worth it. Active management is going to be key, not just for the UK, but for the whole world, the global market.
Thanks, James. We have another question here regarding ESG. This was possibly answered on one of our previous webinars, but worth reiterating, going over again, most certainly. In regards to market sentiment at the moment and the exposure and interest to ESG funds, are you and the team increasing your ESG exposure not only in your ethical portfolios, but in your mainstream portfolios as well?
Yeah, so one of the things we're looking at the moment is, traditionally speaking, TAM's ESG portfolios, TAM's mainstream portfolios have remained separate. And I think what's a great indicator of the environment that we're moving into is that I'm putting a lot of time into putting ESG investments into the mainstream portfolios. And I have the beauty of ESG investments to an ESG fund because of their ESG credentials, and then being able to allocate ESG investments to a mainstream fund because of their return potential. It's just the concept that you don't generate the same returns from ESG as mainstream is laughable. And I hope by TAM putting some ESG investments into their mainstream models is testament to that. And also, I believe that ESG is not going anywhere. It's going to be the biggest disruptor in our lifetime. And in the same way that tech is going to be a huge disruptor, in the same way that, you know, advancements across the board in tech, in smart materials, in the way that we revolutionize airlines and transport, all of these are exposures that I am putting in the mainstream portfolios. ESG is just as powerful. So that goes in the portfolios because it's a huge market disruptor. And it's a great segue from one into the other. It completely justifies the ESG portfolio's existence as their own standalone models, in the fact that we are putting an element of ESG into the mainstream models. I think that's huge for the wider market and for TAM.
Completely agree. Well, yeah, the last question that we have here is quite a provocative one, perhaps. With the markets currently positioned as they are, and with everything that we've discussed today, value versus growth, it's an age-old question. Where do you really see the opportunities moving forward within the equity markets?
It's a really great question. I've been watching, I watch Bloomberg every day, and I would say at least 20% of the entire day's presenting every day is devoted to this single question: value versus growth. And where is it? Two weeks ago, everyone was piling into value. Value was going great guns. For instance, a high quality non-value fund delivered 0.6% in a week. A value fund delivered 12% in a week. So when value rallies, it really rallies. And if you're not in it, you miss it. is very, very difficult to time. So the first thing I'm going to say is value deserves to have a place in your portfolio. Not a huge place, not an overweight, like you're betting on value or you're investing in value, but to ensure that you have exposure to that corner of the market when it does rally. And that's what we approach here. We have funds that have value investing as a style to ensure that when that market does rally, we capture it. Speaking about value versus growth holistically, there's obviously a massive pull to these stocks in value that have been they've been underbought for decades and decades. And I think there's a massive opportunity there, and it will reflate. That trade will come good. People now have been waiting their whole lives, their whole professional careers for value to come back, and it's still not coming back. I think for value to come back, you need to see a bit of inflation. You need to see high growth. You need to see some positive markets. You need to see the recovery stages of a market, of a global economy. I don't think we're quite there yet. Whether we're still in recessionary phase or whether we're in recovery phase, I think we're still slightly in recessionary phase. Interest rates are on the floor. Inflation doesn't look like it's going anywhere anytime soon. There's still a lot of uncertainty in the market from investors about where we're going, and a lot of fingers on the sell button should corporate profits not come good. I don't think that's the environment for value. So I'm going to say for this year and potentially as we move into next year, I don't see the drivers for value. So I'm going to remain more invested in high quality than I am in the low valued cyclical stocks, and will continue to have exposure to them. But I don't think this is the environment for it. But when it does go, it's really going to go very quickly. And I think maybe in the next market cycle, maybe in 2021, you're going to start to see a real interest in that market, and it's going to go. I mean, I just said a value fund did 12% in a couple of days, right? You're going to start to see that prolonged maybe for a year, half a year to a year. It's going to be huge. So there's a huge amount of latent strength in that market. I just think, we've been in a low growth, low interest rate world since the last financial crisis. And that's predominantly the one reason why value hasn't really accelerated. We're still in that environment. So you need to see that lifted before we can go.
Excellent, James. Thank you very much for that. I think that we can wrap it up quite nicely there. We've pretty much gone to time, which is fantastic. Before we go, I will just thank you again for joining us on these webinars. We really do appreciate you taking the time. We are very keen to speak to as many of you guys as possible and support as many of you as possible moving forward. Please do feel free to get in touch with your TAM representative. If for any reason you don't know who your TAM representative is, please do let us know. Send an email to info@tamassetsmanagement.com and we'll get back to you and introduce you to your relevant localized BDM support. We are very keen to support you guys as much as we possibly can. I'll just reiterate that again. James, thank you very much for your time today. Appreciate it as ever. And please remember to leave us any feedback that you wish to. It really does help us in moulding these presentations moving forward. Thanks very much, guys. Take care, and we'll catch up again soon.
Thanks all.